All right, welcome to another deep dive.
Yeah.
Today we're going deep into financial accounting.
All right.
We've got some excerpts here from a textbook called Principles of Financial Accounting. And we're going to try to really unpack the core concepts of this thing called the accounting cycle.
Yeah.
And we're going to focus on how service businesses track their money.
Okay.
And specifically, we're going to be looking at the cash basis method.
Gotcha.
So this is for people who, maybe are starting their own business or just want to get a better understanding of how the fundamentals work without feeling like they need to go get a degree in accounting or something.
Yeah, totally.
Yeah. So the book starts off pretty basically by just saying what accounting is.
Yeah.
And they say accounting is analyzing, classifying, recording, summarizing, and interpreting business transactions.
Yeah. That's a lot of big words.
It's a lot of big words, right?
Yeah.
But really what it comes down to is
Just keeping track of stuff.
it's keeping track of stuff.
Yeah.
It's like it's knowing how much cash you have.
Right.
What you're spending on things like supplies
Yeah.
and how much money's coming in from the services that you provide.
Totally. Yeah, and this is key for helping you make good decisions.
Right.
Like knowing whether or not you can afford to take on a new project or invest in new equipment for your business.
Yeah, it's all about having good information
Exactly.
to make smart decisions.
Yeah, and what I think is fascinating here is this idea of running totals.
Right.
It's not just looking at one transaction in isolation.
Right.
It's about seeing how everything impacts the bigger picture of your business
Right.
over time. And the book points out that we're going to start by looking at revenue and expense accounts.
Okay.
So revenue is simply the money that a business brings in from its operations.
Yeah. Okay.
And they give a good example.
Yeah.
So if you're a computer technician and you repair someone's computer, that money that you earn, that's revenue.
Right.
But if you sell your old van,
Right.
that's a different type of income.
Right. It's not really your core business operations if you're a computer technician.
Exactly.
Right. So this is a good distinction, I think.
Yeah, and for service businesses, which we're focusing on today,
Right.
the book talks about this thing called the fees earned account.
Right.
And this is where you would record any income from providing your service or expertise.
Right.
Not from selling a product.
Right. Like a good example would be like a consultant or, a hairstylist or somebody who's, teaching tutoring services.
Absolutely.
They're earning fees for the services that they provide.
Yeah. And a really critical number that comes out of all this is net income.
Okay.
The book says net income equals revenue minus expenses.
Okay.
And if your expenses end up being greater than your revenue, you have what's called a net loss.
Oh, okay. So that's how you actually determine if you're making money or not.
Exactly.
Is that net income number?
Right. Yeah, it's the bottom line.
Yes, the bottom line.
So the book then goes on to the mechanics of the accounting process.
Okay.
And it all starts with something called the journal.
Okay. So the journal, I'm guessing that's where all the financial information gets recorded.
Exactly. It's the very first place that you record your financial events,
All right.
your transactions,
Okay.
and it's a chronological order.
Right. So as they happen.
Exactly.
Oh, yeah.
And they even show us what it looks like.
Okay.
There are columns for the date, the post-reference debit credit.
Okay.
So you've got your debits on the left and your credits on the right.
Okay. And so debit and credit, I think a lot of people get tripped up on what those words actually mean.
Yeah.
Yeah.
Yeah, they sound kind of scary.
Yeah, they sound kind of scary.
But in this context, they just refer to left and right.
Okay.
So to debit an account means to enter an amount in the left column, and to credit an account means to enter it on the right.
Okay. Simple enough.
Yeah.
Yeah, so it's just left side, right side.
That's it. Yeah.
And debits and credits are two sides of a scale.
Okay.
Every transaction that you make affects at least two accounts.
Okay.
And this ensures that things always stay in balance.
Right.
So your assets always equal your liabilities.
Yeah.
Plus equity.
Okay. We're going to get into that equation
We are.
a little bit later. But yeah, that's a really important concept, I think.
It is. It's like the bedrock of accounting.
Okay.
So, so how do you know whether you put an entry in the debit or credit column?
Right.
It depends on what type of account it is.
Okay.
And whether that account is going up or down.
Okay.
So the book lays out some basic rules
Okay.
for cash revenue and expenses.
Okay. Let's hear it.
So you debit cash when you receive it.
Okay. So that increases it.
Yeah.
Got it.
You credit cash when you pay it out.
Right. Which decreases.
Yeah.
Okay. So debit up for cash, credit down
That's
for cash. Okay.
for expenses. You debit them when you incur them.
Okay, so a debit also increases an expense.
Yes.
And for revenue, you credit it when you earn it.
Okay.
So that increases the revenue.
So it's the opposite of cash, basically.
Okay.
Okay, all right.
It's a pretty simple foundation.
Yeah, it is. I mean, if you can keep those straight, you're in good shape.
Yeah, you're well on your way.
Okay, so now what?
All right, so the book then walks us through what's called journalizing a transaction, which is actually writing it down in the journal.
Okay.
Using those debit and credit rules that we just talked about.
Okay.
So the first step is to identify at least 2 accounts.
Okay.
That are affected by that transaction.
Okay.
And then you figure out the dollar amount for each account.
Okay.
And then based on the rules, you decide which one to debit and which one to credit.
Okay, so we're basically taking what happened in the real world.
Yes.
And translating it into this language of debits and credits.
Exactly.
Right.
Yeah, it's a very structured approach.
Right.
So we can track everything consistently. And when you actually write it in the journal, the date goes on the first line.
Okay.
The account that you're debiting goes first, and it's not indented.
Okay.
And the amount goes in the debit column.
Okay.
And then on the next line, you enter the account you're crediting.
Right.
Indented about 3 spaces with the amount in the credit column.
Okay.
And one thing to remember, no dollar signs in the journal.
Oh, okay, interesting. All right.
Yeah, just the numbers.
Oh, okay.
And they give some good examples here.
Okay.
So for instance, if a company pays its monthly rent,
right, you
would debit rent expense.
Okay.
And credit cash.
Okay, because you're losing cash.
Yeah.
And the expense is going up.
Yep. And then the opposite, if they receive cash from a client,
right,
for services, you would debit cash and credit fees earned.
Because the revenue's going up.
Exactly.
Okay, all right. So that's the journal.
That's the journal.
Okay, now where do we go from there?
Well, you've got all this great information in your journal, but you need to organize it a little bit better.
Okay.
So that's where the ledger comes in.
Okay, so the ledger's the next step.
Yes, it's the second major accounting record book.
Okay.
The journal is chronological.
Right, day by day.
Yeah, day by day.
Okay.
The ledger organizes the same information by account.
Okay.
So you have a separate page or a digital record for each account.
Right, so like cash or rent expense or...
Exactly.
Yeah, okay.
So let's say you want to see all the activity just for your cash account.
Right.
That's where the ledger comes in.
Okay.
It takes all those transactions from the journal and puts them all in one place.
Okay, so it's organized by those different accounts.
Exactly. And each ledger account has columns for the date, a description, a debit column, and a credit column.
Okay.
And then debit balance and credit balance.
Okay, so this is where you keep those running totals that we were talking about.
Exactly. And as the book points out, the running balance is typically in one column or the other, but not usually both.
Okay, it's either debit balance or a credit balance.
That's it.
Okay.
So how does all this information get from the journal to the ledger?
Good question.
Well, that's where posting comes in.
Posting.
Posting.
Okay.
You're basically copying information from the journal to the ledger.
Okay.
One line at a time.
All right, so walk me through that process.
Okay. So first, you locate the correct ledger account.
Okay.
Then you copy the date from the journal entry to the date column in the ledger.
Okay.
You usually leave the description column blank.
Okay.
And then you copy the amount from either the debit or credit column in the journal to the same column in the ledger.
Okay.
And then here's the important part.
Okay.
You have to update the running balance.
Right. So you're adding or subtracting based on what was there before.
That's it.
Okay.
So if it was a debit balance and you're posting another debit, you add them together.
Okay.
If it was a debit balance and you're posting a credit, you subtract.
Okay.
And the book goes through all the different scenarios. So it's pretty straightforward.
Yeah.
Once you get the hang of it.
Okay.
And once you posted something, you go back to the journal and you mark it as posted, usually with an X or a check mark.
So you don't accidentally do it twice or...
Exactly. It's all about accuracy.
Okay.
Because if you make a mistake here,
right,
your ledger account balances are going to be wrong.
Right. And that everything from there
is going to be wrong.
Your financial statements will be wrong.
All right. Well, this is making me nervous.
No way.
It's not that bad.
Right.
The book has a good example.
Okay.
It shows some transactions involving cash.
Right.
And how they're posted to the cash ledger.
Okay.
And how that running balance is updated.
Okay, that's helpful.
Yeah.
Yeah.
And this leads us to the concept of the normal balance.
Normal balance.
Normal balance.
Okay, so what is a normal balance?
This is the side.
Okay.
Either debit or credit.
Okay.
Where an account's running total is typically maintained.
Okay, so for instance...
So for instance, asset accounts.
Right.
Like cash,
Right.
usually have a normal debit balance,
Okay.
meaning they increase when you debit them.
Okay.
Revenue accounts usually have a normal credit balance.
Okay, so it's important to know which side of the ledger, if you will,
Yeah.
that account typically lives on.
Exactly.
Okay.
So if you see a cash account with a credit balance,
Yeah.
that's a big red flag.
Yeah, something's not right.
Something went wrong.
Okay.
And the key here is that the total of all the debit balances across all your ledgers must equal the total of all the credit balances.
Okay, so they have to balance out.
They have to balance out.
Okay, and so if they don't, then you know you've done something wrong.
You've made a mistake somewhere.
Right.
And also, these ledgers continue from period to period.
Okay, so you don't start a new ledger
You don't start fresh.
every month.
Nope.
Okay.
And the book makes a good point.
Yeah.
That if you have an error in your journal entry,
Right.
it's going to follow through to the ledger,
Right.
and it's going to affect your financial statements.
Right. So if you make a mistake at the beginning,
Yeah.
it's going to snowball. Then you-
Exactly. It's going to keep going.
Yeah.
So accuracy is crucial.
Well, that's good to know.
Yeah. So to catch these errors, businesses use what's called a trial balance.
Trial balance.
Trial balance. Okay, so what is a trial balance?
It's a list of all of the business's accounts
Okay.
and their current balances
Okay.
as they appear in the ledger.
Okay.
And you use this to test whether the debits equal the credits
Okay.
before you prepare the financial statements.
So it's like a checkpoint.
It's a checkpoint
Okay.
to make sure everything's still in balance.
Okay.
The example in the book shows a few common accounts like cash.
Right?
Common stock fees earn supplies expense.
Okay.
And it shows whether they have a debit or credit balance,
Okay.
according to the ledger.
Right.
And if the totals don't match,
You know you have a problem.
but go back and fix it.
Exactly.
Okay.
And all this work of journalizing, posting, and preparing a trial balance
Right.
is so that we can do the financial statements.
Okay, so that's the whole point.
That's the goal.
Okay.
And the book talks about this thing called the time period concept.
Time period concept.
Yeah, which just means that companies prepare these reports regularly
Okay.
over consistent intervals.
Right. So it could be every month, could be every year.
Exactly.
Right.
Yeah.
Okay.
And the amounts on these statements are mostly taken from the trial balance,
Okay.
often with some calculations and summary.
Okay, so it's kind of all building up
It all builds up.
to these financial statements.
That's it.
Okay.
The first one they talk about is the income statement.
Income statement.
Income statement.
Okay, so the income statement is all about profit and loss.
Exactly.
Yeah.
It shows how much profit or loss
Right.
a business has generated over a period of time.
Okay.
And it follows a pretty simple formula.
All right, hit me.
Revenue minus expenses equals net income.
Okay. And if it's negative, it's a net loss.
That's it.
Okay.
Revenue is shown first,
Okay.
and then expenses are subtracted to get that net income number.
Okay. And the book mentions if the expenses are higher than the revenue,
Yeah,
then you have a net loss.
you do. And it's usually shown in parentheses
Oh, okay. All right.
on the income statement.
Okay.
So the income statement really gives you a good picture of how the company's performing
Okay.
in their core operations.
Exactly.
Okay.
So now the book introduces us to the accounting cycle.
Accounting cycle.
Accounting cycle.
Right. So what is this cycle?
Well, it's a series of steps
Okay.
that businesses use to track their financial information.
Okay.
And it starts with that time period assumption.
Right. Breaking things down.
Yeah, breaking it down into chunks.
Okay. Like a month, a year, or whatever.
Exactly.
Okay.
And then they start talking about temporary accounts.
Temporary accounts. Yeah. These are accounts that are mainly on the income statement,
Okay.
primarily revenue and expense accounts.
Okay.
And what's interesting about these is that their balances are reset back to zero.
Wait, really?
Yeah.
At the end of every period?
At the end of every period.
Wow, okay.
So after the income statement's been prepared,
Right.
you transfer their balances to another account.
Okay, we'll talk about that in a minute, I guess.
We will.
Okay, so you zero them out.
You zero them out.
Okay.
So you can start fresh.
Every month, every year, whatever the period is.
Exactly. And this is done through something called closing entries.
Closing entry.
Yeah, these are special journal entries that you make at the end of the accounting period.
Okay, so after all the regular transactions are done?
Yes, after the financial statements are prepared,
Right.
but before you enter any new
It's
transaction.
on the next period.
Exactly.
Okay.
And the purpose is to get those temporary accounts down to zero
Right.
for a fresh start. And they walk us through how to do this.
Okay.
So for a service business using the cash basis method,
Right.
you're going to transfer the credit balances
Oh, wait.
in your revenue accounts,
Right.
like fees earned,
Right.
into an equity account called retained earnings,
Okay.
which increases its balance.
Yeah.
And then you transfer the debit balances
Right.
in your expense accounts.
Right, like rent expense.
Exactly,
Right.
into retained earnings,
Okay.
which decreases its balance.
Okay.
The example in the book shows that you would debit fees earned
Okay.
and credit retained earnings.
Right.
And then you would debit retained earnings and credit rent expense.
Okay, so you're moving those balances from the temporary accounts into retained earnings.
Exactly.
Okay.
Yeah, and this whole process effectively moves the net income
Right.
for that period
Okay.
into retained earnings.
Okay.
And the reason you do this is to prevent the revenues and expenses from
Right.
one period
Right.
getting mixed up
Right.
with the next period.
Right, so you don't want to combine January's revenue
Exactly.
with February's revenue.
You want to keep them separate?
You got to keep them separate.
Yep.
Yep.
The book even shows what would happen if you didn't do this.
Oh, really?
Yeah, the balances would just keep carrying over.
Right. It'd be a mess.
It would be a mess.
Yeah. Okay, so those closing entries are important.
They're very important.
Okay, so up to this point, we've been talking about transactions where cash changes hands right away.
Right.
But what happens when you provide a service now and you get paid later?
Yeah, that happens all the time in the real world.
Yeah, it does.
So the book introduces the idea of transactions on account.
Okay, on account.
On
Right.
account.
Okay.
So let's start with revenue transactions on account.
Okay.
So this happens when a business provides a service to a customer,
Right.
but they don't get paid right away.
Right.
They send them a bill,
Right. An invoice.
an invoice, yeah.
Okay.
And they expect to get paid later,
Okay.
usually within 30 days.
Okay. Makes sense.
So if you're a freelance graphic designer
Right.
and you finish a project but you bill them later,
Right.
that's revenue on account.
Okay.
So even though they haven't gotten the cash yet,
Right.
they've earned the revenue.
Right, because they completed the service.
Exactly. So they still credit fees earned.
Okay.
But instead of debiting cash,
Right.
they debit a different asset account called accounts receivable.
Accounts receivable.
Accounts receivable.
Okay, so what is accounts receivable?
This is basically a running list of all the money
Okay.
that customers owe the business
Right.
for services that have been provided
Okay.
but haven't been paid for yet.
Gotcha. So it's like a collection of IOUs.
Exactly. It's like a big IOU pile.
Okay.
And the rules for accounts receivable are the same as cash
Okay.
because it's still an asset.
Right. Right.
Debit to increase credit to decrease.
All right.
And when the customer eventually pays,
Right.
you debit cash.
Okay.
And you credit accounts receivable.
Okay, so that customer's balance goes to zero.
That's it.
Okay.
And the book gives a good example of the journal entry
Right.
and how it would be recorded in the accounts receivable ledger.
Okay, perfect.
Yeah.
So that's revenue on account.
That's revenue on account.
Okay, now what about expenses?
Well, we have expense transactions on account too.
Okay.
So this is when a business buys something
Okay.
from a vendor
Right.
and they get a bill,
Right.
but they're expected to pay it later.
Okay.
So just like revenue,
Right.
the expense is recorded
Right. When it's incurred.
when it's incurred. Yeah,
Even if the cash hasn't changed hands yet.
exactly.
Okay.
So the relevant expense account is debited,
Okay.
but instead of crediting cash,
Right.
they credit something called accounts payable.
Accounts payable.
Accounts payable.
Okay, so what is accounts payable?
This keeps track of all the money that the business owes
Right.
to its vendors.
Right.
So it's the flip side of accounts receivable.
Okay, got it.
And the rules for accounts payable are the opposite of assets.
Oh.
Credit to increase,
Right.
debit to decrease.
Okay.
And when the business eventually pays,
Right.
they debit accounts payable
Okay.
and credit cash.
Okay, because cash is going out?
Exactly.
Okay.
And again, the book has a good example of the journal entry and the accounts payable ledger.
Okay, so we've got these different types of accounts.
You do.
The book then talks about asset liability and stockholders' equity accounts.
Yes.
And these are reported on something called the balance sheet.
The balance sheet.
Okay.
It's another key financial statement.
Okay, and these are permanent accounts.
They are permanent,
Right.
unlike those temporary ones.
Right, so they don't get zeroed out.
They don't get zeroed out.
Okay.
The ending balance
Right.
becomes the starting balance for the next period.
Okay, so they just keep rolling over.
They just keep going.
Okay.
So let's break down these categories.
Okay.
So assets,
Right.
as the book describes them,
Yeah.
are anything that a business owns
Right.
that has economic value.
Okay.
An important principle here is the cost principle.
Cost principle.
Yeah, which means that assets are recorded at their original cost
Okay.
when they were acquired.
Okay, so whatever you paid for it.
That's it.
Okay.
Some common examples are cash accounts, receivable supplies, prepaid insurance, prepaid rent, prepaid taxes, and equipment.
That makes sense.
Yeah.
Okay, so that's assets.
That's assets.
What about liabilities?
Liabilities are amounts owed to others.
Okay, so we've talked about accounts payable,
We have,
money you owe to your suppliers.
yep.
What are some other examples?
Well, there are wages payable.
Okay, money owed to
Yeah,
employees.
okay. Taxes payable.
Okay,
Interest payable.
okay.
Unearned fees.
Unearned fees.
Yeah, this is when customers pay you in advance for
Okay.
services you haven't provided yet.
Okay.
And notes payable.
Notes payable.
Yeah, these are formal written promises
Yeah,
to
notes.
repay money.
Okay, like a loan.
Like a loan, exactly.
Okay, so those are liabilities.
Those are liabilities.
Now, what about stockholders' equity?
All right, stockholders' equity represents the owner's stake
Yeah.
in the business's assets.
Okay.
For a corporation.
Right.
This typically includes two main accounts,
Okay.
common stock,
Okay.
and retained earnings.
Okay, we've heard about retained earnings.
Ah,
All right, so common stock is money that's directly invested by the owners.
exactly.
Okay, and retained earnings is the accumulated profits.
Yes, the profits that haven't been paid out
Okay.
as dividends.
All right.
The book also mentions this concept of limited liability.
Limited liability.
Yeah, that a corporation structure provides.
Right, so you're not personally liable
Exactly.
for the debts of the company.
That's it.
Okay, it's good to know.
Yeah.
So now the book gives us some examples of balance sheet transactions,
Okay.
like how these would actually get recorded.
Right.
So, for example, if you purchase office supplies with cash,
Right.
you're increasing supply
Yep.
and decreasing cash.
Exactly.
Okay.
If you buy a piece of equipment
Right.
and pay part in cash and take out a loan,
Okay.
you're increasing the equipment.
Right.
Decreasing cash.
Right.
And increasing the note payable.
Right. The loan.
Exactly.
Uh.
If an owner invests cash into the business,
Right.
you're increasing cash
Right.
and increasing stockholders' equity
Okay. Through common stock.
through common stock.
Right.
Yep. And when a company pays cash dividends,
Right.
you decrease cash
Right.
and decrease retained earnings
Okay.
eventually.
Okay. Okay.
So this brings us to the accounting equation.
Okay. The famous accounting equation.
Yes, assets equals liabilities plus stockholders' equity.
All right. So break that down for me. What does that really mean?
So this equation has to always be in balance.
Ugh.
It's the foundation
Yeah.
for all the debit and credit rules.
Right.
Because the total debits have to equal the total credits.
Right. To keep that equation balanced.
Exactly.
Yeah.
And it shows how a company's assets are financed.
Okay.
So the assets have to come from somewhere,
Right.
either from the owner's investments
Okay.
or from borrowing money.
Right. So liabilities.
Exactly.
Wow.
And all the revenue and expense accounts that we talked about earlier
Right.
ultimately impact retained earnings.
Okay. So they're kind of indirectly in that equation.
Exactly.
Okay.
The book shows this in the expanded accounting equation.
Oh, expanded accounting equation.
Yeah. Host speaker.